Looking good, Billy Ray!
Feeling good, Lewis!
Well, do I say Merry Christmas? Do I say have an acid capitalist season of festivities? I think that's what I'm going to say. This could be the Christmas edition. And what better way to get you all stoked up than to bring back Sir Tom from London as the sky and the light sets behind him. We have this wonderful opportunity to catch up. My old sparring partner, Tom's the guy who always looks me in the eye and says, I don't get it, which is invaluable. And I suspect there's going to be a lot of I don't get it today. But Tom Roderick, come in from London. There's change of foot. Things have happened in your life. Tell me more.
Hi, Hugh. No, good to be back with you again. Well, I think since the last time we spoke, managed to get our new macro fund launched and off the ground, and so that's very exciting. Trying to get in with the Christmas cheer here in London. We've got like a sort of conventionally Christmassy view, even if we don't have a Christmas tree or Christmas hats.
Humbug.
I was asking about Hugh's Christmas decorations earlier, which I don't seem to be there, but I guess in sunny St. Bart's, it's midsummer all year round. So do you need that?
Christmas doesn't belong in the tropics. We have a Christmas-free safe zone, but the festivities certainly belong here. And I've been trying to I've got to up my game to get ready for the festive storm which is coming my way.
Oh wow! Okay, so what is a hurricane warning or?
Oh, just definitely a warning. Things are happening. It's going to be hot here around New Year, but anyway, I'll be ready. But anyway, so you've launched your hedge fund, yeah?
Yeah, it's launched.
Congratulations. Don't reflect upon this, but managers do sit down and prepare thought pieces, and it's a bitch to do, but it's a wonderfully cathartic event. I know you haven't quite finished yours, but I'm hoping that you can kind of reveal some of the entrails and bring it to the fore, and we'll try and have that conversation. As we start, it seems that as we go into 2023, I think it's like a double bluff, but it's like, okay, so the bond market, which is really good at this stuff, and yield curvatures, and where the forward rates start anticipating pivots from the central bank, and that market's been going, you're getting it wrong. And now the double bluff is, what if the market mechanism, which has the greatest record of foresight, what if it's wrong? This is just the most predicted recession, and therefore we should fade the most predictable, and actually the sunny uplands of next year is we're going to be okay. Are we going to be okay, Tom?
Well, I'm sure we will all be okay on some measure. And you're right. Like, I think this time of year is always an interesting time. It's when people start to slow down for Christmas, for New Year. And you see this in markets as well. You often see what happens, particularly in late December, set the scene for what happens in January. You always have the January effect, where if you see positive performance in that month for the S&P, you often see the whole year being a good one, and that effect often starts actually middle of December, not in January. So it's been a fairly rough couple of weeks for equity markets, particularly after the Fed came out and sort of suggested that, contrary to what the market was seeing, they're still worried about inflation. They still want to go forward and and add more interest rate hikes to the system. So it's an interesting time, and yeah, I'm kind of most of the way through my sort of 2023 thought piece, and it's always good to try and get those words down onto paper, to translate them from sort of meandering thoughts into your head into something more tangible that you can share. And I think this is, when you look at 2022, looking back on it, it has really been a profound year. You've seen a massive sell-off in equities and bonds, which have been the best friends to portfolio managers and investors everywhere for many, many years, have really failed in their role to protect portfolios. And I guess the real question is, whether this is the start of something or whether we're already at the end of it. Because as you and I both know, there are different views on, for starters, you expect equity markets to go down, maybe 1 in every 4, 1 in every 5 years. It's very, very rare for equity markets to go down 2 years in a row. I think the last time that happened was it, you probably know better than me, was it 2001, 2002? We saw back-to-back down years. Since then, remarkably, we haven't had that. Next year, I actually do think I'm actually expecting that we do see another down year in equities next year, and that's something which is quite rare. And so, predicting that is not without risk. It's always a dangerous prediction to make. Particularly, well, I guess we've had a medium down year. Where I think the S&P as it stands is about down 18% on the year. So, it's kind of middle ground. It's not really. It's not a big sell-off, but it's also one that's hurt for a lot of people, particularly if they've used bonds as a portfolio hedge.
Yeah, I think it's been the most impactful 18% drawdown, like you say, given that nothing else has prevailed to hedge you. But yeah. So why? I mean, so well done. It's quite bold to kind of go for a consecutive down year. What's your thinking there?
Well, so my thinking is, and this is what I've been, this is sort of like the words I've been putting to paper in the last couple of weeks. I think that paradoxically, the reason why we need to see another down year in equities is because we do have actually fairly decent economic strength. If you look at the labour market across the Western world is extraordinarily strong. There just, for whatever reason, there's a lack of labour supply, and seemingly it's the same in China. You look at Chinese working age population data. Their working age population has basically dropped about 50 million in the last 5 years. And so it's my view that one of the main drivers of the economic world that we've been in since the 1980s really has been the rise of China and the emergence on the world scene of this vast, initially very underpaid working population glut, who came onto the world scene and competed with Western labour. And as a result, you saw, strong gains for those at the top of the tree in the West, the capitalists, the top 1%, and you saw strong gains for, lower income people, in China, but also, across Asia. And you saw the Western middle classes really suffer. And I think that's one of the reasons why you're seeing this big backlash against globalization is for that reason. The kind of the driver for me was that Chinese population glut, which I think is coming to an end. I think the China and its economic policy is broken. They vastly overbuild on housing. Their population is going into decline. The capability for them to keep on producing cheap goods for the West, and I think this is an important point, producing cheap goods for the West, whilst having their wages suppressed by central government to mean that prices were lower than they otherwise would be. I think this entire process is coming to an end. And this entire process is coming to an end because there just aren't the population anymore to bring from the rural interior of China onto the East Coast. And as a result, that big competitor to Western middle class wage earners is gone. And as a result, I think the downward suppression of inflation and prices has gone. And I think the era where returns on capital significantly outperformed returns on labor, I think that age has also come to an end. And so big claims, I know.
It's big supposition, which is founded on like one kind of demographic. The 50 million thing is a bit like, the whatever, 80, 90 trillion dollars of, derivative debt exposure, which always comes out. These are all the kind of phantoms in the machine that people would like to kind of wage. The reality on the ground is that China in the last few years has again recorded a trade surplus with the rest of the world to the effect of like over 1% of global GDP, which is simply enormous. And whilst there is for sure it must be drying out the ability to take the peasants from the village to the metropolis. It is still allied with an incredible infrastructure. So like what I want to say is the idea of you can't replicate that in Vietnam. You just don't get Vietnam just random. But you could tick the box in terms of young workforce, the amount that you'd be paying, productivity adjusted, and then productivity adjusted with the infrastructure. It's still a little bit tenuous. And then the fact is they're still aware over the last 3 years pumping these things out. So it's conjectures. You are proclaiming something which is yet to happen. Maybe we could say something about how you think that there is a wealth transfer that the central government levies on the household sector. What is the principal force of that? I mean, I think I know, but I'd like you to say.
What is the wealth transfer? Well, there's many different ways you can look at it. It's essentially the government controls large swathes of the economy and essentially gets to dictate how the economy is run to a very large part. And taxation and the way that companies and individuals have to pay for things is not that set in stone. And so, if you're a housing developer in a particular local authority who does particularly well, you will get taxed more. The central government will find a way to take away those profits from you. And
the government, Tom, or is it the local government? I thought it was the local government.
Sorry, the local government. Sorry, I just got a bit distracted there. The local governments will do that, and also the level of the return on savings in China has been very, very low. Interest rates have been suppressed. If you look at the performance of the A-share market over the last 20 years, it's been massively lower than Chinese GDP growth. Essentially, return on capital is suppressed, savings income is suppressed, and the government controls a vast swathe of economic activity. That's what I would say. I don't know, what would you say? It sounds like you've got a good idea.
Well, the big one would be the external value of the currency, that they stubbornly resist. The clearest form of wealth transfer is that I believe the currency should be trading somewhere between 4 and 5, which would reflect would reflect that economic migration and the production of with these manufacturing hubs. That's the principal thing, because products manufactured overseas, if we were trading with a 4 handle, would be, I can't do the math, it would be like 40% cheaper, and therefore the wealth of the household sector would be greater, their inclination to buy would be greater, and then you would solve for the global deficit in demand. You have a global deficit in demand, and a profound surplus in savings, which has destroyed kind of the proper calibration of money in risk decisions. I mean, that's the age we live in. As I look ahead, my fear, I think you gave mention, they have a GDP calculator. It's like, okay, we want 5%, so we're going to spend, trillions on property and whatever else, and it's coming out at 2. Like, and the pressure would seem, or the inclination to game the system, that pressure is rising, and the currency would be the factor. Against that, the local governments have just lost the financing from the property market, being able to sell parcels of land. So they're really up against it. So you can see how they want to push into further confiscation or further taxation. I think the central government would be like pulling hard to prevent that. So all roads would seem to kind of come back to the balm of the FX.
Well, I think it depends. Like, I think if you were to remove all capital controls and all sort of wage suppression at the same time on January the 1st, 2023, I'm not sure the yuan would rally. I think there's been a major suppression of capital outflows within China. And well, capital outflows because of one desired capital investment, but also, I guess the other side of suppressing wages is, as you said, you suppress consumption, and a lot of that desired consumption is probably for Western goods. And so I think you'd find that the current account would actually very quickly come back into line if you removed that wage suppression. The Chinese sort of productivity per capita, the productivity per unit labor costs in China would very quickly decline. And I think, given the vast overvaluation of Chinese property assets, I think you would see a capital outflow. And so I'm not sure you can say that, all things considered, that the yuan is undervalued. I think the reason it looks undervalued is because of that wage suppression. And if you get rid of that wage suppression, a whole host of other things would happen. And I'm not sure you would actually see the currency appreciate.
I mean, well, again, measuring periods, without a doubt, if you were to fully liberalize that account, then the rush to kind of, to be liberated would have its effect. I think that would have to be measured over a period of, 5 years, and it would have to be matched with other liberal policies to create confidence. But the fact of the trade surplus to the rest of the world being of that it's a magnitude. We have 100 years of like trade, more of international trade data. That is an outlandishly large surplus, which points to something. Anyway, so is China, what a new year beckons? I could bitch about China, all day, but the risk factors, to my mind, the risk factor which is in the background, was at the fore, was Chinese property. That's one of them, right? A risk factor has been the conventional diversification and risk management of Western risk portfolios has stumbled. And then the risk factor is, I've never known the Fed to nail it, to go, right, okay, we got this, and we're pulling back now, and create this kind of optimal flight path where you have this kind of, sure, there's a disturbance from the tightening, but it's not profound enough to create like a severe contraction in GDP. I've just, like you say, a second year of economic of the stock market falling is rare, and it's even rarer to see the Fed execute and have an exit strategy. Fed exiting typically is, my understanding from my observations, is there's collateral damage. The Fed goes, oops, and about turns rapidly.
I think the Fed never exit. The Fed bail. The Fed always constantly end up bailing on their plans. They've done that time and time again. It's recession is what ends the cycle for the Fed, or something that blows up in the financial system, as it did in 2018, when they basically they found out there wasn't enough reserves in the system given the new way that it operated. I think if you look at the situation now, though, it's hard to see that happening. You've had the balance sheet basically double from 4.5 trillion to 9 trillion over the course of 2.5 years.
What is that? That's just laundromat tokens. Like, big deal, like, oh, we got lots of tokens. Does anyone would anyone like to use these tokens in the banking sector? And they resolutely say no.
Well, the way I see it, they might be laundromat tokens, but it's easy come, easy go. If it can go up that quickly, it can probably come down quickly.
Yeah. But like, how? I mean, I just think it's a narrative that's best ignored. I mean, I don't find the Fed's balance sheet with these tokens influences the economic behavior of the bank credit allocators. Do interest rates. Okay, so I think of the Fed's role as really being psychology. Yeah, and like it's a poker game with the Fed and the private sector commercial banks in the United States, right? The Volcker experience, and those banks, they have a binary choice between, if you will, an inflation-proof real asset, which is lending to the private commercial sector in the United States, household and corporates, and they have a rate of interest which they can adjust to reflect if there's a fear of purchasing power destruction, or they can pivot the other way and just lend to the US government, which is to say, just stoke up on 10-year treasuries. Volcker, I want to say, came in, and the banking community is like, you guys are like unhinged, and there's inflation everywhere, and so the predominant balance, our risk balance, is lending to the private sector in the United States, and we feel secure about that. And Volcker had to come in repeatedly and say, you don't get it. I'm kind of crazy, right? The 73, 74 oil induced recession was enormous. It's happening again, so we know it's going to be enormous again, and I'm going to raise interest rates. What are you doing with all these loans to the private sector? You're going to come to regret that. And they came, if you will, they played poker every. How often does the Fed meet? Every 6 weeks or so, and the bank's like, "You're bluffing, you're bluffing, you're bluffing," and then the banks went, "Okay, we're folding. You're serious," and so we switched over in 1982. And so when I look at that poker table today, the banks are the onshore domestic banks who are responsible for the creation of sovereign dollar bills, just have not, if you will, they uppermost in their mind, unlike the 70s, has been more the commercial risks of lending to the private sector in the United States. So the swingometer, they already own the treasuries. What is the Fed doing to? I haven't seen the Fed with their laundromats create a lending boom from the private sector in the United States, the private sector banks. That's helped me there.
No, I think you've had an increase in lending. I think lending for the last couple of years has been pretty decent, and you had massive government subsidies of individuals and businesses, and that created a lot of savings. You can call it forced savings, I guess, which is being drawn down. You're seeing credit card debt go up, but only back to where it was in 2019. It's not like astounding numbers, really, as much as people like to point to it.
I don't like. So do you take, because my interpretation of credit card outstanding balances is one that they're funded out of desperation rather than recklessness. Like it's a funding tap, and when it's escalated, it's because you're drawing down available means to keep your expenditure.
Generally, it goes up in booms, right?
Well, it's so long since we saw a boom that I can't.
Well, yeah, I don't know. It's a single data point, really. Like, clearly, we know that banks have a much bigger desire for asset-backed lending than they do for sort of backs lending. That is very much true. But I do think though that the combination of all of these factors, wage gains, government sponsorship of individuals and corporates, just the level of the economy, did seem to create some form of overheating. And that's why the Fed has decided to hike rates. I'm sure you're sitting here as astounded as everyone else. If we were here on December the 19th, 2021, and I told you, okay, the Fed is going to get to 4.5% interest rates by the end of the year, and I asked you to guess where you thought the S&P would be, I'm guessing that you would say it's a lot lower than now.
For sure.
And so the mystery of this year, what's happened? So how haven't we already blown up?
Yeah. To the point, I had a thought bubble. Forgive me for interrupting.
Sure.
I was perusing the comedy of financial journalism this morning, and someone made, to your point about the 2 consecutive years of decline on markets and how rare it is, and I think we alluded to maybe 2001, 2002, or whatever. That period also coincides with the enormity of the shift in credit allocation to, what do I want to call it, to private investment, to private equity, with 10-year lockups, where apparently private equity is only down 3% on the year. I mean, do you believe that? And if they were stating, and the whole point is, it's a lie, and as long as you don't have to publish and come in with the truth, everyone's fine. Someone was saying it's astonishing that people are so willing to commit, and the biggest commitment is just give me fantasy, just don't tell me the truth. And the fantasy's been allowed to prevail because of we've not had 2 years. It was March 2009 when the Fed finally went boom, and the thrusters took risk assets higher. But it may be that the greatest danger is longevity of modest declines here on from the S&P, where the private equity guys lose the time to maintain the fantasy. And if you cross a point, which is June of next year, where they have to say, we said we were down 3% last year, but we're down 33% this year because we now have to tell you. Maybe that, because these things are psychological. I don't know. It struck me that, and I thought that's kind of interesting. And it kind of tallied with what you were saying.
Yeah, well, I guess going back to your analogy with the laundromat tokens, I guess if you lose a few tokens, you just kind of shuffle the ones you've got a little bit faster, and you hope for the best. And I guess you saw that in crypto markets. You saw Luna go down, but it didn't really seem to cause too much of a systematic issue in markets. But then basically crypto didn't recover. The Fed hiked rates. There was better sources of return elsewhere, and then eventually it turned out FTX was bankrupt all along, and they were just shuffling tokens around in the hope that the boom would come before anyone noticed. And I think, and it didn't come quick enough.
Shuffling may be a rather generous term. They were issuing coins on their exchange, and then there would be odd bits of oh my god, our new stable coin is $60 billion. We've only issued there's only 1% issuance. Dear Mr. Credit Allocator, how much new dollars would you give us? Oh, $60 billion. Oh, thank you very much.
Yeah, but I think that's happened, and I think, yeah, you're right. I'm sure private equity valuations must be down more than 3% this year now. I'm sure wherever they're marked, they're not marked low enough. That much we can definitely agree on. And you're right. I think COVID, in terms of what it did to the equity market, we saw a very short bounce. Private equity just emerged from it totally unscathed. This year, they've just about sort of kept things going. They can sort of, cook the books to a certain extent through, they can choose where to mark the illiquid stuff. But yeah, there does come a time when the things which don't move, which are the things that you should be most worried about when they do move, it gets bad enough that those prices finally do move, and then you start to see the true state of the system. And I think we might be about to find out next year. The way I see it is that, you've got, so Chinese demand was very tepid over the course of 2022, but yeah, they kept producing stuff. Now they're going through this massive wave of COVID. They've decided to just accept that they had it wrong, basically, and the rest of the world had it right. And they're all going to join the party in 2023. There's going to be Chinese consumption to join, what was a fairly small disruption in Chinese supply. That's going to come back. In the UK, we haven't had as many strikes as this in December since the 1970s. There's rapid unionization. There's big labor demands for extra wages.
Is there rapid unionization, or is it like old dinosaur unions in key public sector areas, which represent monopsonies, flexing their muscle? And even then, like the train guys have been on strike for ages. The longer you go, you just lose the sympathy of your customers. They're like, guys, really?
Well, I think the train drivers don't get much sympathy. I think the nurses do, and the firemen do, the postmen do. They have a lot of these guys haven't been on strike.
I mean, everyone uses emails. So one of the thrusts of your argument is the health of the labor market. I might have to look. I haven't really seen any really scary charts on compensation, US compensation. You have, presumably. So
I say that health. You can present it as health, or you can present it as a sickness, because in some ways the labor force has shrunk, and you can say that obviously that's partly just because of aging. It's also because it seems to between COVID and now there's been a big dropout of people from the labor market, somewhat due to sickness. So there's less people. It's not necessarily health per se. It's just what was kind of taken as a given that companies could hire and fire. Companies could fire and then just find someone to replace the person they fired whenever. Those assumptions have kind of gone out the window.
What are you saying? What is annual compensation year over year? What are we seeing? Because that's a long-standing relationship. I can remember we looked at that for many, many years, and you anticipate it flares and then it just comes back again. I mean, I haven't.
So if you look at the lower end, if you look at like lower compensated workers, they've had pretty serious pay rises. They've had inflation-busting pay rises in the US, and remarkably, it's for the first time since the Atlanta wage data started in 1997, you are seeing a sustained outperformance of lower wage earner wages relative to higher wage earner wages, which suggests that you're not being. It's not a skill based. It's not a skill based compensation increase. It's a lack of quantity of workers based premium that's happening in the market right now, and that just hasn't happened. That hasn't been seen for 25 years, but it happened this year. It's still happening.
But it could still be just this unknown fact. We had a profound non-economic shock, a health shock on the universe of the population of the Earth, and there are consequences that we're still coming to terms with. One of which has been the withdrawal of labor. I think particularly acute in the lowly compensated community, and therefore it's created a dearth. It's created an abscess. The supplies become tight, and the market is being rational. It's bidding more. But again, the thrust of my question was: we have aggregate data, right, which is obviously the totality, the average of the totality. My sense is it's behaving in terms of wage.
But I think this is partially just because it's, demands for wages in an inflationary environment lag substantially. We've only had higher inflation than target for about 18 months. Everyone's been talking about how it's transitory. Maybe it's just transitory, but it's going to last a long time. But it's only really now that you're seeing these demands. I think it takes a while for people to notice inflation, and it takes a while for people to accept that, okay, this has been a meaningful deterioration in my quality of life because my wages are not keeping up with inflation. And so I think it just takes a while to feed through the system. And I think the fact that you have this shortage there, I think the economics point towards wage earners getting a higher compensation next year, regardless of where inflation is. They're going to demand higher wages to catch up with where they think they ought to be. And because there's a scarcity problem, they're probably going to get what they want. And that just hasn't been the case for a very, very long time. And so
it's easier to say that. People have been, it's not like they've been passive. I mean, their living standards have been dropping at an atrocious level for decades. It's not like they've just accepted it. There hasn't been a wage negotiation where they've said, "Can we have more because I can't live on this?" Right? So.
But the conversation has gone, well, hey, no, we can give your job to the guy who's working in our factory in China instead of you. And so, there's
you're saying that it's no longer a deterrent. That's where I can't. I still.
I'm not saying it's going to completely disappear overnight, but I think there is tightness in that China does not have excess labor anymore, not to a significant extent. Their reaction to these COVID protests suggests that the government is feeling the pressure on some of their repressive policies. They repress people's freedoms, but they also repress their wages. Chances are they're going to have to start treating people a bit better. And so, the ability of...
So the big surprise is that Z, all-commanding Z, turns out to be like this benevolent uncle who actually, given he's wrestled control of the system, can then start... The hesitation on their part is they never wanted the tenure of the CCP to be subject to a household consumption boom. They've had linear GDP progression. They haven't really had cyclical GDP progression where you have recessions, because they fear recessions are a challenge to their authority. Are you saying that now he's achieved some official authority, longevity, that now he can take that risk? I mean, that's a big statement. I hope so, but
Well, I think partially the game's up, right? There's only purpose in suppressing wages if you feel, if when you had, let's say you had, 200 million people brought in to work on the East Coast in more productive stuff, and there's still 300 million people working in the field. It kind of is a rational strategy for an autocrat to suppress the wages of those 200 million, take some of their proceeds, reinvest it to kind of build the monster until you've employed everyone. And we basically got to that stage. China doesn't need any more infrastructure. It's overbuilt in terms of residential housing. It's probably overbuilt in terms of transport infrastructure. Urban population growth has slowed to a trickle. Working at population growth has actually gone into decline. What's the point? There's no point in wage suppression anymore. It managed to go on.
It's really the dominant. It really, perhaps that is the dominant narrative as we switch years, because the commodities have been atrociously bad, yeah, which really can only be explained by the neutering of China.
Yeah, I think
there's no more. I mean, when you look back on this year, again, if you take your narrative, what if I was to tell you by the end of the year we'd have seen 40-year highs in inflation? And I was to tell you that all the key commodities were like just way down, especially off their intra-year highs, way down. That would be a surprise. And how would you explain that now? No.
That would be, it would be a big surprise. I think, I don't know, I can hazard an explanation. I'm not sure it's the right one. I would say copper boomed in 2021 on the back of sort of all of these really high PE, like green future stocks, which are sort of like talking about, building a decarbonized future in the West, using lots of copper, using lots of, resources to build electric cars, windmills, solar panels, all of this stuff. And because all of this stuff was like so far out in the future, it all got crushed this year because it was very, very interest rate sensitive. And I think the story behind longer term metals demand got crushed with it. But that said, that doesn't really explain what's happened to oil. Oil has also performed very poorly. I guess you can put that down to a very poor economic performance of China, who've used a lot less oil than people expected, as well as Russian oil continuing to flow out onto the market. I don't know. It's somewhat of a quandary.
No, but masters of the universe, you can't have quandaries. You've got to have answers. I'm on another screen looking at the charts, and God, I'm getting so frisky when I look at those charts. I'm like a twitchy lady. I'm twitching. Because you put them onto monthlies and what have you, and I'm looking at futures charts, and they're not carry adjusted, so they're a little bit distorted. But what you see is we had the 2006, 2007 highs in the commodity complex, and then obviously a profound liquidation. We had the silly, hey, the central bank is printing dollars, 2009, 2011, which created just an appalling capital allocation where mines were built and they destroyed shareholder wealth and created disdain for the community. And then you had, like with copper and whatever, the green revolution. And then, of course, you came back to the narrative of the Fed printing money. And so you made all-time highs. But if you look at it in the context of 20, 25 years, they broke the ceiling of 2007. And of course, they've come back. Market spread confusion. I have to say, I mean, I have no idea what happens next year, but when I look at those long-term commodity charts, it just makes me feel that they are going to go boom like that. But just in my messed up, eclectic asset capitalist mind, there's always drama. And I think this is the drama. I reconcile it in that the Fed is going to smash the economy on a temporary basis, but real contraction in asset prices, and it's going to feel acutely deflationary. And I promise everyone, if we get like 1% treasury yields or less than 1% treasury yields, you've got to be just sucking up every damn commodity. Markets are all about fakes. I mean, forgive me because it's just sounds like I sound particularly mad this morning, but that's.
So, are you thinking this is going to happen in the first half of next year?
I mean, like you want me to give the precise date? You know that I've been proclaiming. That we agree in that notion of market cycles, which kind of last. The central tenet of some of the stuff we've discussed previously is you've kind of got 35, 40 years to accumulate savings from your productive endeavors as you enter the labor force. Let's say you enter at 20 and you exit, between 50 and 60. And there's a lucky generation and an unlucky generation, but there's something about that 40 years which kind of plays in my mind. So we had the bankruptcy of the US financial sector in 1930. And 40 years later, we're in the 1970s, we deleveraged the system, right? And there's it's a bit choppy, and then we move on to another cycle. That 40-year cycle is ending. And I think the mistake that people can fall into is like, it's ending right here. All my chips on the table now. I'm doing it. And markets, they protect. Because if you imagine we get a hyper like bull market in those commodities, the market's just not going to say, yeah, no, come in now. And it's like I say with treasuries, markets like, oh, right, yeah, you and everyone decided that the treasury bond market is over. And we're going to go like in a linear fashion in Chinese style from 50 basis points to 16 percentage points on treasuries. It's not going to happen. There's going to be a head fake.
Yeah.
You know, it's like, you know, I'm Jesus, you know, I'm Jesus. But the guards come in and they're like, well, that guy in St. Bart's, never met him before in my life. You know, that's the game that markets play. Anyway, stop me talking like a mad person, Tom.
The comparison to Jesus, that's a new one. That's a new one.
Spending too much time in London in the dark dens of an anyway.
But yeah, no, like I think the big cycle is coming to an end. I think that,
okay, so tell me, but you have further declines in equities. So as you see it in your mind, is that a purge? You know, is that the collateral damage where we know that 22, 23% on the S&P and the Fed's like, not interested. We got this. We're purging inflation, right? Is that part of, you know, Rubini was saying, you know, the Fed always capitulates, right? We just don't know the level. Is that your narrative that next year we get a further, more electric purge in asset prices, which brings on the capitulation from the Federal Reserve? Is that your thesis?
Yeah, I think they will. Yeah, and I think the danger for the markets is every time equity prices rally, the Fed has to do more, and so there's a dangerous game in sort of the market bidding up equity prices, because the more they do, the more damage the economy is ultimately going to have to face if the Fed, as they normally do, continue on their mission until they break something, which I have no doubt that they will. That's always what's happened.
But you have great confidence that the system is really quite robust. So give me the breakage? This is good. This is a good vibe. Let's keep this going.
Where's the breaking point?
Yeah.
Well, we don't seem to, but we don't. I don't really see strong signs that we've reached it. That's for sure. So to put it like this, when I was researching my note, I was very surprised to see that compared to the end of 2021, US house prices are still up on the year. They're up like 10%. Crazy. You know, so we've seen some fall.
Where's the stock market? The stock market is up. But at the end of 21, the stock market is up more than that, no?
Stock market. So this is house prices.
Yeah,
no,
house prices are up 10% from the highs recorded at the end of 2021. Yeah.
Well,
at the end of 2021, I want to say the S&P was 3,500.
Well, we've gone. I know that we're down 18% this year now.
Yeah. Okay. I'm looking. Like, speaking to you, and I'll come back and I'm fact checking you.
Yeah. And yeah, so like, yes, you can say the housing market's about to break, but come on, you need to take out 2022 gains first. We're not even talking about 2021 gains. We're talking about 2022 gains. Like,
I thought you were talking 21 gains.
No. This is 2022. This is from December.
Well, I mean, the S&P is obviously
22.
No.
It's still up. So that's like, you know. So I actually think, okay. So here's a thought experiment which I've sort of tried to play out as a way of working out, okay, what will the future potentially look like? Let's say that the current model of replacing wages with debt availability in the West has come to an end. In that, you know, we know that wages have been lower than expected in the West because, you know, China has come up and they have produced a lot of stuff.
Yeah, we know that.
Consumption. So let's say you were to unravel that model. What needs to happen? And what I came up with is, okay, so if you take global wealth relative to global GDP, at the end of 2021, it was 500%, which meant there were the value of total assets in the world was 5 times total production. If you look back to before China entered the WTO, in 2003, that number was 300%. And so, essentially, the PE ratio of the world has gone up from 3 to 5. And, the Western sort of median wage earner hasn't noticed that much because, debt availability has increased so that they can sort of just about, maintain the standard of living they want to achieve. If you were to kind of to take the debt out to shrink that kind of PE ratio of the world back from 5 to 3, you'd basically need 2 more years like this one. So you need 2 more years where nominal GDP growth is 10%, and equity markets down 20, average bond portfolio down 10, with the housing market, let's say, up 5%. You need 3 back-to-back years to get back to where we were in 2003. And I think this is important because
Let's clarify again. You're saying 3 years of 10 nominal GDP and 3 years of back-to-back 20% contractions in equity markets.
Yeah.
Would take you from 5x wealth to GDP to 3x.
Yeah, which is where we were before China
entered 2002 with WTO.
Yeah.
Right.
And I think this is important because, I think a lot of the reason behind the rise of populism, behind the frustrations of people, is not so much that they can't afford consumption, it's that they feel that they can't buy a stake in society through buying assets, through buying a house, through buying stocks. Yeah. And so I think that number is important. And I think, as we've been in this low interest rate world, which is somewhat forced upon us by China, to my opinion, it's meant that you've just seen this staggering wealth relative to GDP. And if you've got capital, great. If you don't have capital, it's been kind of shitty. And so that's what you need to do to get back to the world as it was before this massive distortion unloaded itself upon us.
Is recurring 10% nominal GDP growth compatible with 3 years of 20% declines in risk assets?
Well, I guess, housing can take more of the hit. But I think it's pretty tough. Yeah. So, I basically came to the conclusion that without high nominal GDP growth, it can't happen. And, obviously that high nominal GDP growth this year has basically been 0 real percent growth, 10% inflation. That's basically the only way out. And so, my belief is that the system has basically organized itself to create inflation because we need inflation.
Well, okay, I hear that. So where I don't get it is, okay, but if we create inflation, then the surprise last week was the Fed raising terminal rates by another quarter point ish, yeah. And so the surprise or the nasty side of creating inflation is, well, what if that's 8? I mean, I still maintain that 5.25, with debt being almost 4 times GDP, is the equivalent of the Federal Reserve being at 20% rates in the 1970s. So I find 5 is a grotesquely concerning number. And that's why I'm fearful of collateral damage extending into the new year to call the bluff of the Federal Reserve to retreat. So inflation causes a change, a very nasty change in the cost of carry of the debt, which then can cause a purging of asset prices, which then very quickly becomes deflationary. How do you break that? How do you circuit break that?
Well, you just need enough inflation to smooth it over.
But the more inflation, the higher interest rates.
Well, what I find most confounding right now is that 10-year real interest rates are expected to be about 1.3%. If you look at the Fed's inflation expectation for next year, I can't remember it's something like 2.5%, and they are expecting or maybe it's a bit more than that. And they're
I think
expecting
3.1. They've got inflation coming in. And all the central banks are, converting to somewhere around 3 by the end of next year.
Yeah, and they're basically saying that rates are going to be 5, and so they're going to have real rates at plus 2% next year. Like that is not sustainable. That does not get you where you need to go. The only way that rates are going to be at 5% at the end of next year is if inflation is way higher than that. Well, it's certainly way higher than 5, maybe 10. If inflation averages 10 next year, like rates can end the year at 5. Would you disagree with that?
If inflation ends 2023 on average at 10% versus the previous year, you're saying Fed rates will be where?
No, I'm saying that the economy could probably sustain 5% nominal rate.
Sure, but could the Fed not resist the pressure to be at 8%?
Well, that's really the question. I don't really think the Fed has a very good idea about what they're trying to achieve. They want to bring down inflation because they want to bring down inflation. I think it's kind of circular, and I don't really think they've really thought through the distributional consequences or what's happened over the last 20 years or any of this.
Yeah.
To me, I see the economy as being healthier right now than it was at the end of last year. Stock prices should be lower. Like wealth to GDP should be higher. That, to me, we're moving towards a healthier world, and we kind of want more of the same. I'm not saying we're going to get it. That's not what policymakers are suggesting that they want. It's a struggle. It's not what Who's 10's spread is saying. That's basically saying the Fed is going to have to cut. There's going to be a minor recession. Inflation is going to be really, really low. The Fed has already done too much. If one thing I'm sure about, the last thing we need right now is high real rates. That's just not going to happen.
Well, define high real rates. I mean, they're
positive real rates.
But they are positive real rates presently, depending on the.
Yeah, but that's not what we've realized this year, right? The inflation prints versus actually what you get in the bank has been far from real. It's been a real bind. I would imagine that continues. I just don't see how it's going to work otherwise. I think if you sustain 1.5% real rates next year, i.e. inflation's at 3, the rates end the year at 4.5, something's going to break, and the economy is going to be in recession. I just don't think that inflation is going to break as easily as they think. And my guess is that at some point they will balk. Something in the financial system will break, much as it did with the LDI thing in the UK. And so they will be, if inflation is really high and they try and push up nominal rates too high, I think something's going to get in the way. It's going to block them from doing that. Because, it's all very well to say, okay, on average, if rates are at 5 and inflation's at 8, the economy's fine. But that doesn't mean that some people aren't really, really badly affected. And I think that's the problem with inflation, is that you have all these timing mismatches and stuff still blows up, even if the economy in aggregate shouldn't blow up. If you have one major part which is vulnerable to higher nominal rates, even if inflation is high, if for whatever reason their income doesn't increase with inflation, they're still going to get hit. Any sort of a lag effect really, really hurts you. And I think that's the danger of a high inflation, high rates economy, especially if the kind of the rates and the inflation are whipsawing as quickly as they are at the moment.
Well, again, for me, one of my concerns is that you say they're all the same, but I still draw the distinction between the sovereign dollar creation via the private commercial banks regulated by the Federal Reserve and the funny money, the collateral-based Eurodollar lending system. And so you create this, to my mind, you create this enormous collateral-based system, and collateral being the key word. The collateral is predicated on low rates. The value of the collateral is, at the core of it is 10-year treasuries, and then when the banks are smoking funny cigarettes and they get too optimistic, they accept other assets which they're persuaded are as secure and safe as treasuries until they're shown not to be. But when you challenge the risk-free carry on the collateral, such as the collateral has to reprice 20-30%, the risk aversion that creates, and actually the destruction of money and its knock-on impact on other asset prices, that to my mind, that's been at the forefront of this year's markets, and a lot of that is hidden still by the mark to fantasy in the private world. So
yeah, we've seen it blow up in crypto. We saw the LGI thing blow up in the UK, but that's pretty much it, right?
Remember, crypto is two trillion. That's just gone boom, and that's just the value of crypto. You've got to think that crypto was collateral for risky credit, real credit, enterprises, property, etc. in the real economy. The stock market over 2 times GDP drops, call it 18%, so that's 36, call it 40. So just crypto and the S&P, or all markets, would be about, you've lost about 2/3 of GDP. But to put that in context, I think NASDAQ was probably, I think we saw like 1.4x of wealth, risk asset wealth destruction versus GDP.
My guess is a lot of that was paper money. It never really...
All paper money.
It never really exchanged.
Well,
I think very little was probably exchanged at the crypto peak relative to how much there was. And so I don't know. I don't know if someone has done like an analysis on actual dollar losses in crypto. Well, I guess it's kind of circular, right? Because you create a laundromat token and you start trading it. Someone makes money, someone loses money. It doesn't destroy money per se. So if someone has lost, the guys you had on 2 weeks ago, 3 Arrows, if they lost that money, presumably someone made out like a bandit on the back of that. It's not disappeared per se.
I think
they got given dollars.
Maybe I'm wrong. I think it's disappeared in that it's essentially like a home loan mortgage, and instead of being a home loan, it was crypto. And the providers of the credit or their underwriting standards and did silly things. And now they were very aggressive operators who said, "Please give us the money," but their role is to be aggressive, and the role of the underwriters is to say no. But
who received the dollars for all of that Luna they bought? They bought that off someone in dollars, right? Or probably more likely they bought it off them in Bitcoin. And so it's sort of like an abstraction on top of an abstraction. That's the tricky part, because if you look at your Luna losses in Bitcoin, by the time you transfer that to dollars, it contracts quite a lot.
Yeah, but are you saying if stock markets are 2.2 times GDP and they contract to 1 times GDP, so there's 1.2 of...
Yeah, but that's usually because cash flows have declined and there's been bankruptcies in physical businesses, right? Like
from that situation.
This is just like just laundromat tokens being exchanged all around, and so if one company has lost $2 billion, that it's not because they invested in anything. It's not because that was deployed capital in physical infrastructure. It's just made up paper money, which then got lost. And so if someone has made the same money that Luna has gained. Okay, like a lot of people have wasted an enormous amount of time.
What do you call it? Buy finance, in the sense that they were offering 10, 12, 15% rates of interest because you'd pledge the collateral, and then you would give it to an operator, probably doing a building in Dubai or something. So it was a credit spigot spilling into the real economy, affecting GDP growth.
So you're saying it provided capital to the real economy?
Yeah. I mean, that's where the carry came from. I mean, I know part of the carry was just fictitious market making, moving.
But like, have those condos in Dubai lost value? Probably not.
But if you've had to stop construction of them,
yeah, potentially. But I don't know. I haven't seen that type of thing happen. You know, it's possible. It's possible that's been happening, but Dubai, I think, is doing pretty well at the moment because half of global finance seems to be moving there. So it's probably, if the losses are somewhere, it's probably not there. I don't know where it is. If it's in Chinese real estate, sure.
Yeah.
But
no, it is interesting. You certainly don't hear of investment schemes which have been halted owing to the drying up of a source of credit, which presumably was coming out of finance or whatever, from the crypto landscape.
Yeah, it was a giant circle jerk built on top of laundromat tokens, and the game master is called time, and everyone has gone home. Some people are up a lot, some people are down a lot.
I don't know if it's finished. The part of your a broad thesis about the robustness of the economy, you're saying you kind of like where we are at this point in the year, in that we've had an 18% contraction in stock prices. The Fed's been able to raise rates. Nothing's come apart, so to speak. That the labor market is more than robust. The one thing we haven't mentioned, the one thing that's got a fantastic record of being cognizant of threats and opportunities, is consumer confidence. Household consumer confidence globally is appalling, and it's really screaming danger. Why is that not featuring in your analysis?
No, look, it's a danger. It certainly is a danger. I don't know what that data looked like in the 1970s. I presume it went through periods when it looked pretty bad. I don't know. Like in Europe, with energy prices where they were, I can see why consumers are very, very worried. And I think, in the 70s, the last sort of like widespread Western human inflationary period was the 70s. And it was not great. It caused a lot of problems. You had, if you look in the UK, you had a highly unionized workforce basically demand more and more and more until the capitalist class basically got decimated. And the economy was left in ruin until Thatcher came along. And I think this time, and so I think it's that human fear of inflation and what it means, which is leading to that very, very low consumer confidence. Whereas I think now we're in the exact opposite part of the sort of like the capital to wage cycle. And I actually think that inflation means definancialization. And so I don't think it's such a terrible thing. And so I understand why people are fearful, but I think it's a very, very different time. We're almost at the opposite point of that, like capital versus labor cycle.
Yes.
I don't know if we can. Can I share a screen share?
50.
This is in the US, and so first chart. Early 1970s was basically the peak in terms of the US labor share of GDP. In the UK, it was even higher. Yeah. And my argument basically is that one of the reasons why inflation was so bad in the 70s was because it was based on increased unionized demand for wages, which basically broke capitalism.
Well, there was no globalization, and there was a monetary phenomenon. There were credit institutions, banks, both onshore and offshore, that were very keen to create more dollars, and those dollars were the monetary accommodation. So there were two profound things which were missing. But anyway,
Yeah, and if you go to the second couple of charts,
But hold on, John, because this chart looks as if it's like 2010. So, what is the turning point on that? Where does this hypothetical come in?
So the red line is the actual, and this is basically like a
That
mirror
is
chart.
actual.
And so basically my argument is that we have sort of the world we're going to see in the next 20 years is going to be the mirror opposite of what we saw in the previous 20. And so this is just a reflection. So from I think on this one from 2014 onwards is a reflection, and the red line is what's actually happened. And so basically we're in a different part of the cycle. And if you scroll down to the second chart down,
Just wanted to. I'm like I'm doing a different. Boom.
It could happen. It could happen. But you can see you have these like cycles between labor earnings and wealth, and in the 1970s, you saw the wealth of the top 0.1% in the US decline to levels never seen before you had the re-rise of capitalism and financialization, and you basically saw us go all the way from the low all the way back up to the highs last seen in the Roaring 20s. And so basically my point is that people's perception of how bad inflation is based on what happened in the 1970s, when it was actually really damaging for wages to go up because they're already too high relative to productivity. Whereas now we have the opposite problem after 20 years of wage suppression from the Chinese. And so actually inflation is a good thing. It should be seen as a good thing, not a bad thing.
So Tom, so I think those charts are the change in the historic change in those charts, which are all like early 1980s. And again, it's the low point of central bank credibility, and they're on they win it supposedly.
Yeah,
it's globalization. More and more globalization affected the distribution between labor and capital, was reflected in stock markets.
Yeah,
I don't dispute that. So, question to you: what happens if China, with its GDP calculator broken, opts to kind of guide its currency to 9 or 10 in the order that you see? And remember, that might just be, maybe that is just what happened, because what you're prophesizing is 40 years. And the hard thing about that is the next 5 could be just funky and a lot of volatility that hides the path. And so I'm trying to introduce factors that would create the volatility to your hypothesis.
Well, I think you always have a lot of volatility around the turning points, and yes. I think you saw a lot of volatility around the turning point in around 1980, and you're seeing a lot of volatility today. I think volatility is often signifying of a turning point.
But that's kind of one of my points, whereby the fact that the Fed went to 20 and the 10-year went to 16 in 1982, despite convincing data stretching back at least 2 years that inflation was in the descendancy, not the ascendancy. That was the volatility. That was people just being traumatized by the nowness of what had come to pass. And therefore, that's why I'm still in my head saying the same thing's going to confront us today. That's, the 16, of course, would be the inverse, would be like something very low in treasuries.
Yeah,
I guess I'm offering you the Chinese thing because I know that your response would be, well, that would be profoundly deflation.
Yeah, so I think that if the Chinese yuan went to 9 or 10, what would that mean? It would, well, I guess what would lead us to get there? Because I think it's not going to go to 9 or 10 without a series of events getting us there in the first place. If they open,
you offered that up because you were saying you've lost 50 million active productive agents from the Chinese labor force. You were saying that the calculator, like it's overbuilt in terms of world-class infrastructure. It's overbuilt in terms of residential apartments. Aren't these the factors that lead them looking at like 2% GDP growth and going, this isn't good enough?
Yeah, I think it could. I think you could see. So if you saw the yuan go to 9 or 10, I think what could lead that would be some sort of an opening up of the Chinese economy, unlocking consumption, paying people more, and essentially trying to reflate the Chinese property market as denominated in yuan, which becomes a lot easier if you deflate the yuan itself, because the price of property and the property value relative to GDP in China is just far too high, and so it would certainly solve a problem for China by doing that.
Imagine, but so because again, I'm a sucker for a paradox. What if we just got a glimpse, the COVID, the blank pieces of paper with the brave people daring to protest, and actually it's created an immediate, response from the authorities, which is completely unexpected and completely welcome. What if, and we spent 2 years preparing for, Chairman Xi forever, and think of all the horrible, grotesque things he does. What if that's just a glimpse into liberalization, and actually they come out and say, you know what, this closed current account, that's kind of crazy. We're China. We want to be a global leader here. We're opening it, and they know that as a gift, a kind of demographic gift, a liberalization gift, at the same time, it helps the GDP calculator, and at the same time, actually, it stuffs everyone. It's a very aggressive form of generosity, or a generous form of being aggressive.
Yeah, and then the question comes: is that deflationary or inflationary for the rest of the world if they do that?
Yeah,
because
answer that question.
If you unlock the consumer whilst depreciating the currency, it's kind of hard to know, right? Like my guess is that, well, if China reopens, you'd presume that would be inflationary, because production has come back to normal, whereas consumption hasn't. So that we think, I'm pretty sure that's going to be inflationary. If China has a massive depreciation of their currency, maybe that's just what you need. Maybe that's just a quick, surefire way of solving the problem. You end up having, that creates a massive hit to global wealth, because a lot of that wealth is in yuan. Wealth relative to GDP, Chinese GDP as measured in dollars probably wouldn't change by nearly as much as the depreciation. You'd expect, you'd see continually high GDP growth, but you'd imagine it would be driven maybe more by consumption. So maybe that's the one single shock to the system which would, unravel the repression. Because I sort of think that repression of consumption relative to production was the thing which created the lowflation in the West, and you take it away, presumably you'd go back to where we would be if they hadn't done it in the first place, or something like that.
Well, let's keep at that, because this is like just kicking it between us and game playing and just trying to get the mind to engage. So I still maintain that where we are, that China via's machinations with the currency is exactly what the US did in the 1920s. That the nature of international trade is that you don't get disequilibrium, that economies boom until they lose comparative trade advantages, which are then passed on to their neighbors. And that was gilded by the passage of gold in the 1920s, which was meant to kind of go in as a form of high-powered money to the credit system and make it happen quicker, right? So the US was booming, should have boomed even more, should have become wages, should have got really out of control. Then Europe would have been competitive and we'd have had harmony. And the US, Benjamin Strong et al., denied the ability of the high-powered gold to hit the vaults of the US banking sector, and so you had you had poverty in Europe, and you had a boom in the US, and you had duration in disequilibrium. And I think it's exactly what the Chinese have done. But so it was broken by the Brits rejecting the system eventually. Like, this is just, we've just had perpetual deflation. We're breaking the system. And I come back and I say, is it the US that breaks the system? Is it the extravagant privilege of being able to print?
Exorbitant privilege.
Exorbitant. I keep getting them. Exorbitant privilege. What if actually, how could US policymakers be persuaded to say this actually means so up here? Like, this is actually an exorbitant cost that that our population at large has had to bear these last 40 years. We got to break it.
Well, I guess Trump fighting China and Biden sort of continuing that fight. You started to see that happen, but there doesn't seem to be a lot of sense about it. Like, it doesn't, other than sort of like just poking the bear. Yeah. They don't seem to have got an aim per se. It's just they just sort of seem to have this feeling that that's what the people want, so they do it. But they don't really have an intent. And I don't know. I'm sure that fight will continue. But what would be, I guess something like, what were you talking about in terms of a capital tax on treasuries?
Yeah.
Or something like that. Basically just printing loads of dollars, something which basically depreciates the dollar.
Yeah.
And basically hurts people who are just accumulating too much of their savings in dollars. Because just punishing the savers somehow. Because some of the central bankers referred to it as a global savings glut.
Yeah, Bernanke invented this.
Yeah, Bernanke did, and so basically you punish the saver. You find a way to punish the saver.
I mean, but there's clearly not enough consideration given to that, and maybe that will build. Maybe you just need. I think next year you probably just see a slow, steady movement in the renminbi to like 8 or so. I
think it could happen. Yeah, I think the Chinese might do it on their own anyway.
Yeah. No.
I think the Chinese are no longer incentivized as much to carry on their current system.
Yeah, it's no longer working for them. The GDP calculator, like, nothing's happening.
Yeah, like the current global system is not really working for anyone, right? Everyone's unhappy. The Chinese, it's not working for the Chinese. There's clearly a lot of angst in sort of lower middle class workers in the West. It's kind of worked. It's like the Chinese have gained substantially from it, but they're no longer continuing to gain. The sort of the global capitalists have done pretty well from this, but at the same time, they're probably as incentivized as everyone else for stability. And if we've reached the point where it's no longer stable to keep having very, very elevated asset prices relative to GDP, then I think it kind of suits everyone. They're still gonna be in a better position. If you're a company owner, if you're a stock owner, you want the next 10 years to see real productivity gains, to see real growth. And if the current system doesn't enable that, it's kind of in your interest to see that change as well, even if it hurts your bank balance in the short term.
Yeah. Listen, let's call an end. I mean, people got to go and like cook turkeys and like buy champagne. Champagne's just awful. I really don't.
Well, apparently you can't get turkeys in the UK at the moment. There's a shortage because of bird flu. So, like with everything else, we keep getting all these recurrent shortages. And you'd have thought you'd manage to be able to get turkey for Christmas, but we'll see. I'm not sure what people are going to be eating instead.
Well, I like to go to the tradition we have is we take a boat and we go to Columbia Beach and we have turkey sandwiches and rosé. But I'll keep you posted.
Caviar off golden platters.
Yeah, not for me.
Not for you.
Marshy sandwiches and some.
Or Scottish smoked salmon, imported specially.
Yeah, I don't think you should smoke food, but anyway, listen, Tom. Thank you very much. This is complicated. We haven't reached. We're stuck within the confines of we don't know what happens next. But you know we have the audacity to spend over an hour just trying to kind of like challenge the mind to try and say silly things, and then we'll listen to it later, and hopefully everyone else will listen to it. We're not offering answers; we're just offering mind paths to try and get us out of the way. So if I was to sum you up, you could conceive of another down year. I like your thing that 3 consecutive 20% declines in markets with 10% nominal GDP, regardless of how mutually consistent or inconsistent that is, would deliver. We talked about international trade in these long 40, 50-year developments broke the reputation of central banks. We talked about a GDP calculator in China, which seems to have broken. We've reflected on a very, very small sample, which is the Chinese authorities being liberal a little bit, listening to their citizens. We welcome that. A big wow would be them sort of opening their not their trade account, what do we call it? Their capital account. We did see that at the end of the 1970s. The UK famously under Thatcher did that. We are bemused at how weak commodities have been, despite being weak. When I looked at their long-term charts, I felt like a funky chicken, and I'm still in this dialogue that, again, we talked about crunching changes taking place within cycles which may go on and persist for the next 40 years, and that would be a return away from capital to the labor force. But we warned that in the first 5 years of that, it could be full of profound volatility, which would serve to confuse everyone of the direction. Am I missing anything?
No, I think you summed that up pretty well. And yeah, when I went back and I looked at the chart of copper over the last 7 years, like, okay, it's down on the year, but most of the late 2020 and 2021 gains are still there. So it's basically just gone up, sort of kept most of its gains. It's kind of the same with oil, right? So
they're all trading at the previous all-time highs going back 10, 15 years ago, and that's an interesting place to be.
Yeah.
What happens next? I tell you what happens next. Christmas cheer.
Christmas cheer.
As capitalist households around the world, we wish you a very fine festive time. We hope it's a period where you can reflect and catch up on your reading, and I'm going to be catching up on my Suntan.
Well, as always, speaking to you has been a Christmas cracker.
Boom, boom. Okay, we are over.